What is unfolding in the silver market is not a rally, not a squeeze, and not a speculative event. It is a structural fracture between pricing systems that were designed to appear unified, but were never meant to be stress-tested simultaneously. The China export ban is not the cause of the disruption. It is the trigger that exposes how fragile the global silver market has become under layered claims, jurisdictional bottlenecks, and artificial liquidity. The key mistake most observers make is focusing on the price itself. Price is downstream, control over flow is upstream. What matters now is not where silver is quoted, but where it can physically move and where it cannot. The emergence of three distinct silver prices is not a market anomaly. It is a governance failure made visible. In Shanghai, silver trades at a panic price because Shanghai represents consumption under constraint. This is the price paid by entities that cannot substitute, cannot delay, and cannot afford interruption. The Shanghai Futures Exchange does not operate primarily as a speculative venue. It is an interface between state priorities, industrial demand, and inventory control. When silver trades at a materially higher level there, it reflects urgency, not exuberance. In the Middle East, silver trades at a physical clearing price. This is a market still functioning, but under stress. The UAE does not face the same export constraints as China, yet it demands a premium because global sourcing has tightened. This premium is informational. It tells us that outside China, physical silver is scarce but not yet rationed. In New York, silver trades at a synthetic price. COMEX pricing reflects financial continuity, not physical accessibility. It is a price formed by leverage, netting, and rolling behavior. When physical movement is possible, the system works. When movement is blocked, it becomes detached. The widening spread between these three prices is not arbitrage inefficiency. It is arbitrage impossibility. Arbitrage requires three conditions: price discrepancy, transportability, and time. The China export ban removes time, licensing requirements remove certainty, border enforcement removes transportability. Once these constraints exist, arbitrage becomes theoretical rather than actionable. The market knows this. That is why the spread widens instead of closing. This is not a failure of traders to act. It is traders correctly recognizing that metal cannot be moved fast enough to monetize the gap. The bridge between paper and physical is not congested. It is closed. This has immediate implications for how we interpret delivery data. A 26-fold increase in delivery demands is not a speculative bet. It is a positional exit. Large participants are not expressing bullishness. They are expressing distrust. Standing for delivery is the only way to convert a paper claim into a physical asset before jurisdictional constraints lock the system. This behavior reveals a critical truth. Paper silver functions smoothly only when participants believe they will never need the metal. The moment that belief changes, the system destabilizes rapidly. Delivery spikes of this magnitude are not random. They occur when counterparties realize that rolling contracts forward exposes them to future non-performance. Once an export ban becomes imminent, future delivery is no longer equivalent to present delivery. Time itself becomes a risk factor. This is why delivery volume matters more than trading volume. The COMEX was never designed to handle sustained physical settlement at scale. Its inventory structure assumes that only a small fraction of contracts will ever stand for delivery. The system relies on the law of large numbers and behavioral inertia. When that inertia breaks, liquidity transforms into liability. For bullion banks, this creates a balance sheet crisis, not a pricing one. When banks are short paper silver and long confidence, they function normally. When confidence evaporates, they must source metal in a market where metal is already scarce. This forces them to buy high while delivering low. Every ounce settled at a loss drains capital. This is why emergency liquidity operations become necessary. Repo injections are not a response to market volatility. They are a response to settlement stress. Cash is required not to speculate, but to bridge losses created by forced physical delivery into a higher-priced physical market. The scale of recent liquidity injections is revealing. Billions of dollars are being deployed not to stimulate growth, but to prevent default cascades. This is defensive liquidity, not expansionary policy. The Federal Reserve's role here is often misunderstood. The Fed is not intervening in silver, it is intervening in plumbing. Its objective is not price control, but continuity of settlement across the banking system. When bullion desks face delivery obligations they cannot easily meet, the risk propagates into interbank funding markets. This is why a commodity delivery event becomes a systemic liquidity event. At the same time, Shanghai inventory withdrawals signal something even more consequential: strategic accumulation. The pace of withdrawal is incompatible with normal industrial usage. Factories do not increase consumption 14-fold overnight. This is not production-driven demand. It is preemptive capture. Entities withdrawing silver at this scale are not responding to price signals. They're responding to policy signals. An export ban converts silver from a tradable input into a strategic reserve. Once that transition occurs, the metal exits the market ecosystem entirely. Every ounce withdrawn under these conditions is not merely consumed, it is removed from circulation. This permanently reduces global float. The consequences of feedback loop. As inventory declines, urgency increases. As urgency increases, hoarding accelerates. As hoarding accelerates, price becomes irrelevant. Availability becomes binary. This is why the market bifurcates instead of repricing smoothly. Industrial actors understand this intuitively. Their procurement decisions are governed by continuity risk, not price optimization. Paying a premium is acceptable. Losing production is not. This explains why corporate buyers are moving off screen. Large entities do not want to signal distress. They negotiate privately, pay quietly, and secure supply discreetly. The most severe shortages are often invisible until inventory is gone. Retail markets experience this as rising premiums, delayed shipping, and out-of-stock notices. These are not distribution issues. They are symptoms of upstream capture. The physical market has already repriced. The paper market is lagging because it is structurally insulated from immediacy, until it is not. This divergence cannot persist indefinitely, but its resolution will not be orderly. Markets that rely on trust resolve crises either through repricing or through restriction. When repricing threatens stability, restriction is chosen first. This is the phase we are entering. The critical point is this: the silver market is not breaking because demand is high. It is breaking because mobility is constrained at the same time. Demand becomes non-negotiable. When a commodity cannot move freely across borders, price ceases to be global. It becomes local, political, and strategic. That is the transition now underway. The defining feature of the current phase is not the shortage itself, but how the shortage is being financed. What appears on the surface as a commodity disruption is, beneath it, a liquidity management operation designed to prevent a mechanical failure of the banking system. When physical delivery accelerates inside a paper-dominated market, the stress does not manifest first in price. It manifests in cash demand. This is counterintuitive to most observers, but it is consistent with how leveraged settlement systems function under strain. Bullion banks do not default immediately when metal is scarce. They default when cash becomes insufficient to bridge the gap between contracted prices and replacement costs. The silver market is now operating in that gap. The moment delivery requests surged, bullion banks were forced into a negative carry position. They sold silver exposure at paper prices and must now source physical metal at prices set by constrained jurisdictions. This spread is not theoretical. It is realized at settlement. Each ounce delivered at a loss is a direct drain on liquidity. This is why emergency repo operations escalate precisely when delivery volumes spike. The Federal Reserve is not reacting to headlines or charts. It is responding to settlement stress signals transmitted through primary dealers. These signals indicate that without immediate liquidity, delivery obligations would propagate losses through interbank funding markets. The timing of these operations matters. Liquidity injections during year-end are not routine. Balance sheets are typically minimized, not expanded. When emergency funding appears during this window, it indicates that institutions cannot wait. Obligations are immediate, not deferrable. This distinguishes structural stress from volatility. Volatility is managed with margin adjustments and collateral calls. Structural stress requires cash. The role of repo operations here is to substitute time for metal. Liquidity allows banks to delay asset sales, delay defaults, and delay recognition of losses. It does not solve the underlying shortage. It only prevents its immediate systemic expression. This distinction is critical. Cash can stabilize balance sheets temporarily. It cannot replenish physical inventories. As delivery pressure increases, bullion banks face a constrained set of options. They can draw down internal vault holdings, source metal externally at a loss, or attempt to negotiate delays through administrative channels. Each option carries risk. Drawing down vault inventory reduces future flexibility. Once inventory is depleted, the bank loses its ability to meet subsequent obligations. Sourcing externally locks in losses and exposes the bank to further price divergence. Delaying delivery risks, reputational damage, and legal escalation. None of these are sustainable strategies. This is why we observe procedural friction emerge. Settlement delays, compliance reviews, and extended delivery timelines are not operational accidents. They are defensive mechanisms. They slow the rate of depletion without formally declaring non-performance. From the institution's perspective, delay is preferable to default. This behavior mirrors classic bank run dynamics, but with a critical difference. In a traditional bank run, depositors withdraw cash. Here, counterparties withdraw metal. Cash is supplied by the central bank. Metal is not. This asymmetry defines the crisis. The Federal Reserve can provide unlimited dollars. It cannot provide silver. The more liquidity is injected, the more it highlights the irreversibility of the physical constraint. This creates a paradox. Liquidity support stabilizes the system in the short term while accelerating long-term distrust. Market participants interpret emergency funding as confirmation that something is wrong. This incentivizes further delivery requests. The result is a reflexive loop. As more entities stand for delivery, banks require more liquidity. As liquidity injections grow, confidence erodes. As confidence erodes, more entities seek physical exit. This loop cannot be broken by monetary policy. At the same time, the geographic concentration of refining capacity amplifies stress. Even when metal exists in raw or semi-refined form, it cannot be converted into deliverable formats instantly. Refining introduces time, jurisdiction, and regulatory exposure. When refining jurisdictions tighten export review processes, even temporarily, the physical pipeline constricts further. This creates localized shortages that propagate globally. In such environments, futures prices lose their signaling function. They reflect hedging flows and algorithmic behavior, not supply conditions. The real signal migrates to delivery premiums, queue length, and allocation notices. This is why premium expansion matters more than spot movements. Premiums reflect immediacy. Spot reflects abstraction. As premiums widen, they encode information about replacement cost and availability risk. Dealers adjust premiums not to extract profit, but to ration limited inventory and hedge future restocking costs. When premiums spike across unrelated regions simultaneously, it indicates a global constraint rather than a local disruption. This is precisely the pattern now visible. Industrial buyers exacerbate this dynamic unintentionally. Their procurement behavior is rational but destabilizing. Once a firm decides to secure months of inventory instead of weeks, it removes supply from the market at an accelerated rate. This forces other firms to respond similarly. Just-in-time systems collapse quickly once one participant defects. The silver market is particularly vulnerable to this behavior because inventories are thin relative to flow demand. Unlike bulk commodities, silver stockpiles are not designed to absorb sudden shifts in holding preference. When holding preference changes from exposure to possession, inventory drains rapidly. This is why delivery data should be interpreted as a measure of trust, not demand. Entities standing for delivery are signaling that they no longer trust the system to perform in the future. Trust, once lost, is difficult to restore. This has implications beyond silver. It challenges the assumption that paper markets can always intermediate physical risk efficiently. Under normal conditions, they can. Under policy-induced fragmentation, they cannot. The silver market is revealing a broader vulnerability. Global pricing systems depend on free movement. When movement becomes conditional, prices fragment. This fragmentation does not resolve itself through convergence. It resolves through hierarchy. The price paid by the actor with the least flexibility becomes dominant. In this case, that actor is industry. Industry cannot substitute silver easily. It cannot delay consumption indefinitely. It cannot hedge continuity risk with derivatives alone. When industry bids aggressively for immediacy, financial markets eventually follow. This is not because industry is large. It is because industry is inflexible. Financial actors can roll, net, and defer. Factories cannot. This asymmetry ensures that physical markets ultimately discipline paper markets, not the reverse. But the process is disorderly. The transition from paper dominance to physical constraint is rarely linear. It involves delays, temporary suppression, and administrative containment. Price discovery lags reality. By the time the price adjusts visibly, the inventory adjustment has already occurred. This is the stage now approaching. The final stage of this event is not a price explosion. It is a reclassification. Silver is transitioning from a globally priced commodity into a strategically governed resource. Once that transition is complete, the concept of a single global price ceases to be meaningful. China's export ban should not be interpreted as a trade policy adjustment. It is a declaration of prioritization. By restricting outbound flows, China is explicitly choosing domestic continuity over global market equilibrium. This is not unprecedented. It is consistent with how states behave when a material shifts from commercial input to strategic asset. What makes silver different is timing and dependency. Silver sits at the intersection of energy transition, electronics, defense systems, and monetary hedging. Unlike oil, it cannot be easily substituted. Unlike copper, inventories are thin. Unlike rare earths, its pricing has been financialized through paper leverage for decades. This combination makes it uniquely vulnerable to sudden policy shocks. Once a state intervenes at this junction, market mechanisms lose authority. The export ban converts silver inside China into a captive resource. Metal held domestically is no longer part of the global float. It does not respond to price signals abroad. It responds to internal allocation decisions. This is the moment where arbitrage dies structurally. Arbitrage assumes fungibility across borders. It assumes time consistency. It assumes legal symmetry. The export ban breaks all three. Even if price differentials exist, they cannot be closed because movement is prohibited or delayed beyond commercial relevance. This means that price spreads are no longer inefficiencies. They are jurisdictional facts. Once markets accept this, behavior changes rapidly. Producers stop selling forward. Refiners prioritize domestic clients. Dealers reduce exposure. Inventory holders hoard. Price references become advisory rather than executable. This is how a global market fragments into regional regimes. The Shanghai price becomes a strategic price. It reflects not just supply and demand, but state intent. The Middle East price becomes a transactional price. It reflects availability under stress. The New York price becomes a residual price. It reflects financial continuity without delivery assurance. These prices no longer converge because they serve different functions. Attempts to force convergence through paper mechanisms will fail. Futures contracts cannot compel exports. ETFs cannot unlock borders. Liquidity cannot manufacture atoms. This is the point at which paper silver loses its role as a universal hedge. Hedges only function when settlement is credible. When settlement becomes conditional, hedging instruments morph into basis risk generators. Participants holding paper exposure believe they are protected until they attempt conversion. At that moment, protection dissolves. This is why industrial users are abandoning price-based procurement strategies. They are shifting to availability-based strategies. Contracts are being rewritten. Delivery clauses are being tightened. Penalties for non-performance are being escalated. This shift is irreversible. Once procurement departments internalize that price does not guarantee delivery, they no longer optimize for cost. They optimize for certainty. This structurally raises the floor under physical prices. The retail market experiences this last, but feels it most viscerally. Premiums expand not because of speculation, but because replacement risk becomes unquantifiable. Dealers cannot hedge inventory reliably. They must price defensively. When retail premiums align with industrial transaction prices, the paper benchmark becomes irrelevant to real-world acquisition. This is not manipulation. It is adaptation. Markets adapt to constraints by rerouting around them. When rerouting fails, they harden. The silver market is hardening. This hardening expresses itself through rationing, prioritization, and quiet exclusion. Not everyone is cut off simultaneously. Access becomes tiered. Those with relationships, volume, and strategic relevance receive supply. Others wait. This is the opposite of price discovery. It is allocation. Allocation regimes do not collapse loudly. They persist quietly until a new equilibrium forms. That equilibrium will not resemble the old one. The old system assumed that leverage could substitute for inventory. It assumed that trust could substitute for custody. It assumed that time could substitute for immediacy. Those assumptions no longer hold. What replaces them is not chaos, but hierarchy. States secure supply first. Strategic industries follow. Financial intermediaries adapt last. Retail participants receive what remains. This hierarchy explains why price charts lag reality. Charts reflect the last layer, not the first. By the time a new price regime becomes visible on screens, the structural transition has already completed. This is why focusing on countdowns and deadlines misses the point. The decisive actions occurred before the law became active. Inventory was withdrawn. Contracts were converted. Liquidity was mobilized. Positions were reclassified. The event horizon passed quietly. What remains is normalization under new rules. Under those rules, silver will trade differently. Not continuously, but episodically. Not globally, but regionally. Not transparently, but strategically. Paper instruments will still exist. They will still trade. But their relevance will be conditional on physical credibility. The market will remember this episode not as a spike, but as a reset. A reset in how value is determined. A reset in who sets it. A reset in what price actually means. This is not the end of the silver market. It is the end of its illusion of unity.